It's at the point where, to me, this is such an extreme bubble. If you're hanging in there to say, well, maybe it goes another 3 or 4 or 5 months, I'm like, get out. What my research does show 100% is that when a bubble like this bursts, you're going to see 40 to 50% crash in the first 2.5 months. The whole crash is going to be 80 to 90%. I'm estimating 87% for the S&P 500 and maybe slightly higher for the NASDAQ. I'm going to be shocked if we do not see a downturn. So it's as simple as this. We're in what I call the orgasmic phase of this bubble. It's just been building and building. People have to realize since 2007, late 2007, baby boomers peaked in their spending. We had a peak in the stock market in late 2007, and we went into the first deep recession since the early 80s and the early 30s, okay, the Great Depression. And that's when the Federal Reserve and central bank just went nuts. We have printed more money in the last year and a half or so than all of the printing before this, and even since 2008 and 9. I mean, just years and years of this. So they keep doing exponentially more. So they're just desperately keeping this bubble going. And when you get in this phase, there's no way to say, oh, it's going to happen this day or this month. I mean, I was able to predict the 2007 top because I could precisely determine within several months when the baby boomer was going to peak and momentum was going to turn down. But this is just, a bubble's going to go until it bursts. I'm now looking literally at chart patterns and things like that to see when this bubble looks like it's going to pop. And this looks like one of the times right here. And if you sit and wait for that, it'll happen before you're ready, and then you'll panic when that happens, and then it'll bounce, and then you'll look like a double idiot. So this is very tricky. What I'm telling people, you have an economy that's now been stimulated for 12 years against fundamental demographics, against slowing even technology. All of my cycles are slowing at this point, and most of them for years. It will not take much to break this bubble. That's what I'm saying. So just them saying we're going to have to taper and just starting, they're already cutting $30 billion a month in buying bonds, and they're supposed to finish tapering that and then raise interest rates by March. They just keep pumping it up, and the markets keep buying. I mean, at this stage, the market will only go down when something triggers that's big enough, or the last person gets in the stock market. And it's hard to tell which of those. I think what typically happens, this has been every top in this, boom since the early 80s. When the stocks markets go up for about a decade, they usually get pricked when the interest rates, inflation starts to rise late in the boom, and the bond rate, the bond rates go up. Now, the big thing right now, which is extremely unusual, we have 6.8% inflation and rising, and the 10-year Treasury bond is yielding 1.4%. That's like a negative yield of 6-7%. So I think the Treasury bond keeps edging up. That could be the trigger, but we're just way beyond this thing.
But the Fed knows this, right? So won't they do everything in their power to avoid a stock market crashing? This is what they've been working so hard to avoid. They've been pumping. Why would they just put their guard down?
You got to remember, there's a lag to everything. Monetary policy lags about 18 months in its real effect. And so they've been forced to start to taper off. What I keep telling people, you got to understand addictions, you got to understand bubbles. They're both the same thing. Something blows up, it takes exponentially more to keep a bubble or an addiction going. And all it takes is just pulling back. You don't have to stop the stimulus, just less stimulus. And then no stimulus is all it takes at some point. So now they're forced to get a little more tight. Well, if they're going to decide, if they pull back and immediately get easing quickly, it's going to look like they're panicking. So now that they're in a tightening mode slowly, it's going to take them a little while to respond and go the other way. And in that time, again, remember what I said at the beginning, 2 to 3 months, every major bubble burst has happened within 3 years, and it's been from 42% to 50%. And my calculations on this one that's been so stretched is it's going to be 54% the first crash. If that first crash happens, if they just slip that long, people will lose confidence in this market. Imagine if the S&P dropped, 54% in 2 months. You think anybody believe, oh, well, they'll just print money again, it'll come back. You will not see the market come back if it crashes that much. I will almost guarantee you that. In a stock crash like this, after a major bubble, everything will go down, including utilities. It's just those sectors will go down 40 or 50%, and then the leading sectors will go down 70, 80, 90. So that's the difference. There is no safe place to hide. I have the best inflation indicator in the world, workforce growth. No economist would think about that. Incorporating young people into the workforce takes investment in computers and trainings and offices, all this sort of stuff. That's the biggest correlated with inflation over time. Inflation has been falling since 1980, right with my indicator. It should be 2% today. And what's it at? 6.8. We'll call that 4.8% inflation created entirely out of the recent stimulus. So that's what the stimulus has done. As soon as we have a slowdown in the economy or they stop stimulating, I agree, inflation's going to fall off. We could be at peak now or soon, but it's going to take a drop in the economy. If the economy does not slow down, we do not have this downturn, then inflation is likely to edge up at least for a little while. But inflation's already up way more than it should be because of stimulus. And the stimulus is no longer escalating. They're looking at tapering it. So I say, yeah, we're probably near peak inflation and it should go down to 0 or negative. And when we come out of this downturn, you are not going to see inflation over a couple percent for the rest of my lifetime. And most of the people listening to this, almost guaranteed. Workforce growth is going to be damn near 0 as we go into the future for the US. And Europe and Japan and the Eastern Asian countries developed are worse. So inflation is gone forever. What tends to trigger recessions and stock market crashes after a really good boom like this is that inflation starts rising from overcapacity and overstimulation and all this stuff. And then that triggers, slowing the economy, that triggers stock markets to crash, and then that builds, and then that washes out inflation, brings high unemployment, lower spending, and that brings inflation down. This is a totally artificial economy, which means when it blows, it's going to blow even harder. It's not even real. I think January is the most likely time for that. I think it may have peaked in November 22nd, okay? Because I've been tracing stock markets, different sectors here and around the world. Almost everything is already peaked except for the NASDAQ and the S&P. Small caps are down 13, 14%. A lot of countries have been down for months. Emerging markets have been down for over a year. The bond market peaked a year and a half again, the corporate bond market. These are all leading indicators that say we're building towards a crash. And like I say, it's hard to predict. When does that happen? It's possible November 22nd was the peak. We could also get a peak sometime in the first quarter. I'd be extremely surprised at this point if we don't peak and get that first crash starting in the first quarter. If it goes past then, I'm just going to be like, I don't know what to say. I mean, literally, there's a point where you have to say, I don't know what to say, because this has never happened. Governments have never fought a bubble like this or boom, which they created. This bubble would not have happened without governments. 2000, 2007 bubbles, those were more natural. This is totally artificial. Remember, I was the most bullish guy in the whole country in the 1980s when this boom was just getting going, and people thought, oh, this was just a short-term thing. People thought Japan and Asia was going to take over the world and the US was dead. So I've been predicting the greatest boom in history, and you can't have the greatest boom in history without it coming down hard and strong and having a big crash. That's just the nature of markets. They go both ways. But what's happened uniquely here, we're in this basically confrontation between central banks desperately printing ever more money to keep us from shaking out the greatest bubble in financial assets in history, the greatest debt bubble in history, and now global, more than any time in history. This is a big deal, but it's bearish only because we're coming out of the most bullish period in history. So it's not a bad story. We have to shake out these excesses, or the millennials will never be able to invest at reasonable rates, and the economy can't rebalance and prepare for the next boom. And again, I've been predicting the next boom forever would be the millennials from 2024 into 2037. Not as long as the baby boom and not as steep, but we will see another boom to follow this in the US and more so in Asia, especially India this time, in China and Southeast Asia. So there's more boom to come, but this is going to be the biggest crash, right, the biggest downturn of your lifetime is what I'm saying. And most of it's going to happen probably in 2022.